This is Michael Hall from the Milner Group. We appreciate you joining us. Today for our webinar on retirement insurance, we're going to be Jake Bailey, our resident guru, CLU CHFC, is going to be presenting some ideas. And just as a reminder, we've got several of these other webinars on our website, good places to go and find concepts that can help you create larger sales opportunities. One of the things we keep hearing from our agents is that they really appreciate easy concepts that they can kind of take and plug in and create some opportunities and create some value for their clients. So with that, I'm going to turn it over to Jake. Jake, thank you so much. Take it away.
Thanks, Michael. I'd like to thank everybody for taking the time to be on this call. Today we're going to discuss a topic that I'm calling retirement insurance. Now, this won't be a discussion of how to build a life insurance retirement plan per se, but rather how to use a cash value life insurance product to safeguard your retirement assets, especially during the distribution phase when you're in retirement. So in other words, we'll be discussing how life insurance can, quote, insure your retirement, not how it can replace it. These concepts are simple that we're going to discuss today, but they're powerful, and I think that you can use them in your practice to open new sales opportunities that you may currently not be getting. Okay, so let's get into it. We've got one client that we're going to follow today throughout this webinar. We'll call him Mr. Black. He's a male, age 45, and the year is 1970. Okay, why did I actually mention a specific year? Well, the key point here is that he's going to retire at 65, and that's going to be in 1990. So his retirement period, he's planning on, he thinks 25 years is sufficient to take him to age 90. So that's what he's planning in the back of his head. Why do I bring up the real numbers? Well, I'm actually using historical data, market data, using the S&P 500 to approximate what the market actually did during this time period. So the numbers we're going to look at today are real for somebody that retired back in 1990. So this particular guy, he has, by the time he gets to 65, for our purposes, he has saved, in his retirement plan, he saved $700,000. Doesn't sound like a lot, but when you take inflation into account, $1990, that would be $1.5 million today. Okay, and he's planning on taking $60,000 a year. Again, doesn't sound like a lot, but in today's money, that's 120. So he's doing pretty well in his retirement. So let's get into it. What are the things that he would be thinking about, that many of your clients would be thinking about as they approach retirement? The big one that kind of starts everything off is, am I going to have enough money for retirement? Okay, that's kind of a difficult question, right? There's a lot that goes into that, a lot of market factors. What does the market do when you're accumulating money? What's happening when you're taking money out in retirement? What sort of assets are you putting your money in? How much do you put in? What sort of plan do you use? Do you use something that's taxable or tax-free, or what kind of blend? So there's a lot of things that go into that complicated question. Okay, you also have to think about taxes in retirement. So, and also when you're accumulating, are you going to have something like so many retirees have right now, where so much of their money is in a traditional qualified plan that is going to be fully taxable when they retire, right? They got the tax break on the beginning, but they're going to get hit in the end. Okay, so we're going to talk about how it's important to have a tax-efficient portfolio. Okay, inflation is a big factor, right? Inflation is basically like flushing money down the toilet, right? You can think of it as a negative return. It's really important that your client does think about this and that you bring it up, because inflation historically has been about 3% a year. It's not 3% every year, but over time it's 3% every year. Some years prices go down, sometimes they go up a lot. It averages out about 3%, and it certainly did over 1990 to 2014. Okay, so you have to be able to take this into account so that during a distribution in your retirement phase, you have to make sure that you are outpacing inflation, right? Or your money, your actual spending power is going down. So this makes a huge difference, and we'll look at this This will be one of our key points today. Also, a big thought in your client's mind is market downturns, okay, market crashes. Now, when you're younger, you can, and you're accumulating funds, you can kind of ride this out, right? You can afford to take that extra risk, and you probably need to in order to get enough money for retirement. But traditional wisdom says that during retirement, you probably want to be in much safer investments in case there's a crash, you don't totally lose out. But when you think about inflation, you might find out that you really need to have a higher return than what you may have planned. So you might need to keep money in somewhat riskier investments. But what if we had a way to kind of tone down the risk in those investments using an insurance product? This will be our main point today that we'll discuss. Another major factor affecting your retirement is health, right? I'm not talking about actually going to the hospital. We'll assume that your clients have some sort of medical insurance in place. So we're talking more about, say, a long-term care need. What happens to your clients' retirement funds if they have a stroke or something and have to go to a long-term care facility for several years? That kind of stuff is expensive. And even worse, what if they have a spouse that's still in really good health and that long-term care event decimates their retirement? So we'll talk a little bit about that. Premature death. I'm not going to talk much about this because I know that it's your bread and butter. You talk to your clients every day about how life insurance can help them and their family in the case of premature death. But I think when we're talking about life insurance in a retirement plan, it's important that we use a phrase like life insurance is self-completing. This plan is self-completing. If you don't make it to retirement, those funds are going to pass on to your spouse tax-free. And also, obviously, we know life insurance is an efficient way to transfer assets to the next generation. Okay, so these are all the things that are on your client's mind when they're thinking about retirement. So let's look at tax first. This is going to be really quick because I know we've gone over this a lot. I just want to look at an example here. Okay, we mentioned that this client has $700,000 in 1990, year one here. He's taking out $60,000 a year, and he's growing that at 3% a year. So he's taking out more and more every year. And this is assuming that his money remains in the market, something approximating the S&P 500, and these are real figures. So the red line is if he has his money in a taxable account, and I'm only assuming 28% tax, which is historically low, okay? The green is assuming he's in a tax-free account, like a Roth IRA plan. You can see the taxable account is just decimated, okay? And what we would have to assume from this is, look, if your money is in a taxable account and you've only saved this much money, you're taking out too much. You're going to have to live, you're going to have a lower standard of living, okay? That's a hard conversation. However, if you're in a tax-free account, you're doing pretty well. You're making it out all the way to 85, okay? Maybe not quite to the 90 that you had planned, but we're a lot closer to taking out an appropriate amount of money. So in this particular example, at only 28% taxes, we're getting 7 more years just by having a tax-efficient portfolio. So my main point in bringing that up is that life insurance is very tax-efficient and can be a great addition to a retirement plan. Okay, what role does inflation play in this? So it's a big deal. $1 in 1990, to buy the same thing a dollar would buy in 2015, you have to have $2.10, over double the amount of money. So what does that mean for a retiree that may have just thought, you know what, $60,000 a year, it's 1990, that's a good amount of money, I'm going to be fine. Well, that would be like $120,000 now, so it seems good, but he really needs to be taking more and more money out each year in order to maintain his standard of living. If he takes a flat amount of money out, basically his purchasing power is going down every year. So you can see, taking out $60,000 in year one, we're all the way up to $120,000 by the end of his retirement. And this is going to have a huge impact. Okay, so what I did was I took this client's $700,000 and I said, what's it going to take percentage-wise if you want to take out that kind of money with no inflation, just take $60,000 a year, what would you have to earn in order to make it to your goal? In this case, 7.84%, okay? So he's got to do pretty well. He's probably not going to be able to just move all his money into a bond portfolio or even worse, much worse, CDs or something like that. He's going to have to be somewhat aggressive. However, the picture gets way worse, and this is my main point here, gets way worse if you have inflation in the picture. So he's taking out $60,000 and he's taking more and more every year. In this case, to make it to his retirement goal, he has to earn 11% a year. So he's really going to have to keep some risk in his portfolio. What can we do to mitigate that risk? Because that's scary and we can't put the client in that position. What if we had an insurance tool we could take care of that with? That we could take care of market downturns, okay? And this is a cool concept. So this concept really kind of hit me when I first heard about it, and I think that it's really a cool tool, really a cool concept, but it's very simple, okay? And your clients are all going to understand it. So here's what the S&P 500 did during the 1990 to 2014 period. Your clients are afraid of what? These big troughs, okay, in 2000 and then 2008 again here. If they're still taking money out of their retirement plan during these periods and they're still open to all of this risk, this is going to be a big deal. It's going to decimate them. Okay, so that's why traditionally you'd go into much more conservative investments. But what if we could kind of eliminate some of the pain that this is going to cause? All right, that's where this comes in. This is kind of what I'm going to call weathering the storm, and we're using a cash value life insurance plan to weather that storm. Here's how it works. You can see we're starting retirement at 66. These are the actual returns the S&P 500 did. You can see we got some great years in here, and this is going to be a big deal. We've also got some kind of bad years, some really bad year here in 2008. So the way this works is we're going to set up a retirement insurance plan, okay? And that's just a cash value life insurance plan. There's all kinds of different ones that'll work. Could be indexed UL, could be whole life, could be a current assumption product. But the point is, when there is a negative return, now we don't have foresight, okay? Your client's going to hit those negative returns. But the year after a negative return, we're going to take a withdrawal from the insurance plan instead of from the retirement plan. Now, it took me a minute to wrap my head around why this was a big deal, okay? The reason that this works for your client is when they take money out of their insurance plan instead of out of their retirement plan after that negative year, what normally happens after a big draw? Normally, if you look at history, there's a big bump in the market. It goes back up, okay? It corrects itself. It doesn't just continually go down. And we've seen this even with the huge drop we had in 2008, right? Went way back up. So if you don't take money out after a negative year, then you have more money in to take advantage of that upturn. And it makes a huge difference. So during this time period, there were only 6 years that were negative. There were some big ones, but only 6 years. And so every time it's negative, he takes money out of this insurance plan. What would it cost him to do this? Okay? So if he funded this plan at age 45, it only costs him $550 a month for 20 years. He stops putting money into it completely at 65 to fund this plan. He has insurance benefits. He has chronic illness, critical illness benefits, and he's got this insurance factor that allows him to take a little bit more risk in his portfolio. Okay, so what difference does it make? If you look at him at a tax-free account, so he's being very efficient, but he has no insurance, his plan runs out at 85. So he's totally run out of money at 85. We're assuming he's still alive and his plan has fallen short. If he had the insurance and took out only after a negative year, he's still got $650,000, almost as much money as he started with. He's still got in his plan. That's how much of a difference just taking money out of an insurance plan would make during those years. And the good news is he makes it all the way to 90. He's got $380,000 in there still. He's got $38,000 still in a death benefit in his life insurance contract. So he's got a burial policy plus money to pass on to his children. A much better story than completely running out of funds prior to death. Okay, you can see this is a very powerful tool that allows a client to stay in a somewhat more risky position. What does this look like? Okay, So the black line here is what the S&P 500 was doing, what the market was doing, and the blue lines I drew here are the years that we take money out of the insurance plan. Okay, the green line represents what our portfolio is doing with insurance. The red line represents what it's doing with no insurance. Okay, so you can see the plans kind of follow the curve of what the market is doing, except that the red plan, when there's a plunge in the market, it goes farther down and it recovers way less. That's the big point. You can see we have a very small recovery with no insurance. With the insurance, we have a huge recovery just because we didn't take out money after a negative return. Okay, that makes a big difference. You can see we go back up, another plunge in 2008, and this time the plan with no insurance, it just can't recover. It just tanks. Okay, just because we didn't take out money during these 2 years, our plan recovers again with the insurance, and it keeps going throughout retirement. That's pretty much the story there, weathering the storm with a life insurance contract. Very powerful and simple concept to talk to your clients about. What's it look like on an illustration? In this particular example, I used North American's index product. It's very strong. It's got a lot of good features for your client. You can see all we did was fund it for 20 years. He's got insurance during all this time. That's the accumulation phase. And then distribution, we just took money out of this plan when we needed to after a negative year. Okay, that's all there is to it. This is not any more complicated than a regular life insurance retirement plan. In fact, I would say this is probably a simpler sort of plan, because in this case, you're not trying to convince your client that they're going to use life insurance for a majority of, all of, or even a majority of their retirement. You're just using it as an insurance product like it's intended. Okay, you're using it to bridge the gap over bad years in the market. And if they don't ever have to take money out of it, well, great. They can pass on money to their children tax-free. Just to show you that I didn't pick 1990 to 2014 just because it looked good. This works wherever you go. Okay, here's a hypothetical period from 55 to 79. They would have run out of money with no insurance at, let's see, age 81. With the insurance plan, they make it all the way through age 88, almost to their 90 goal. Okay, so another additional 7 years, very strong. Okay, final concept is negative market returns may have a huge effect on your client, but another thing that's going to have a huge effect is what if your client has a stroke or something, goes to a long-term care facility, and man, those are expensive. What effect is that going to have if they're not separately insured for that? Well, thankfully, our life insurance plan can also have a chronic illness rider included. So say this guy makes it to 70, has a stroke, and he's still, functional enough. He's still healthy physically, but mentally he's kind of gone, and he actually lives in that facility for 5 years. Kind of longer than usual, but it could happen. He's taking out a little over $5,000 a month. That's what the facility is costing. Now, what if that had to come out of his retirement plan? Okay, his plan would lapse. He would run out of money at 79. Okay, and that's sad because his spouse was relying on that money, and his spouse is still healthy. What if he had the insurance plan, though, and this money just came right out of his life insurance contract? Remember, you can access the death benefit, not your cash value, the death benefit for a long-term care need. He gets to take all that out of his plan, and then when he dies, his spouse has 10% of the death benefit, $36,000 to bury him with, and their retirement funds last through 85, a good 6 years longer. So you can see whether or not it is a downturn in the market, whether or not it's being tax efficient, whether or not it's a major long-term care event, having an insurance plan, and it doesn't have to be very expensive. In this case, remember, we're talking $550 a month for 20 years. Not that expensive. This sort of plan can give your client a lot of safety during their retirement period. Okay. This just shows you that your plan lasts 6 years longer during a long-term care event than it would without the insurance. All right. that pretty much wraps up the concepts that I want to talk about today. Like I mentioned, it's very simple, but I think very powerful concepts. Now, all of you should have a chat box on your screen. If you'd like to ask a question, the lines are muted, but feel free to type a question in. And if there's any questions, Dwayne can ask those to me, and I will do my best to answer them. Dwayne, do we have any questions?
Not currently. Let's give it a moment, and here we go. So have you compared this with putting an extra $550 a month from age 45 into this regular retirement plan?
Yes, I have. Whether or not that's obviously the first question that would come up. Whether or not that's going to be better is going to depend entirely on what the market does and when the client retires, as you know, related to market downturns. So like if you retired right after a downturn or right before one, and how you managed that would make a big difference. So certainly in some scenarios, just putting the money into a retirement plan, especially if you had space to put it into a tax-efficient retirement plan, then that could be better. However, we're talking about this as an insurance plan. We're insuring retirement. So it's kind of a different concept entirely. And one thing I would say is that all of the numbers I used were assuming we were in a tax-free environment. So we're in some sort of Roth plan. Now, your client, to accumulate that kind of money as quickly as he did, probably was maxing that out already, potentially. And so he wouldn't have had a tax-efficient choice. If we looked at something that was fully taxable, and I did look at that, then the insurance plan definitely beats that thoroughly. But yes, that's a good question.
Okay. Which carriers do you like for retirement insurance?
I like carriers that are low cost, highly rated, and have good features for the client during retirement. For instance, I always use loans that are fixed because I don't want that extra element of risk in retirement. So somebody that guarantees a wash loan would be a good one. North American does that. Several of our carriers do it. I would say that probably the better carriers, North American is probably the best on IUL. I would say Mass Mutual is the best for a whole life contract. John Hancock has a pretty good contract on their indexed UL. So does Minnesota Life, although there's some features in there that are a little bit tricky. So I would say probably the most efficient ones are North American, Nationwide, and Minnesota Life on an IUL, and then Mass Mutual on a whole life for sure.
Okay, let's see. We had someone asking about the slides. I'm sure we can send you out a copy and everything here at the end. Also, just to let everybody know, we are recording this, so we'll have that posted and everything too, probably by the end of the day. Let's see. Is the interest on the loan included in the illustration?
Absolutely, and that's one of the points I would just brought up. In the life insurance contract, I used fixed loans. And with North American, they're a guaranteed wash. What does that mean? They say that they guarantee they'll credit you 3% on money that's loaned out, and they'll guarantee they won't charge you more than 3%. And that's all factored into the illustration. So it was a very realistic scenario. I also didn't run it at a maximum illustrated rate. You may have noticed I bumped that down to 6.5%, and that product's got a 13.5% cap, so that's fairly conservative.
What's the best product for the strategy? Cash value, death benefit, etc.
Okay, that sounds kind of like a duplicate question. I would say North American right now. These sort of things change, and that's kind of what we keep on top of with the Milner Group. But right now, North American.
Okay, let's see. Can the product be whole life or UL? I assume
Absolutely.
The presentation was using a UL.
I used an IUL, but it could definitely be whole life. Whole life is more expensive, so the client would have had to put more money into it. But as you know, whole life has more guarantees as well, so that's kind of the trade-off.
All right. And see, do you have any brochures or carrier brochures explaining retirement insurance that you could send out?
I could. I actually have one. I believe that Lincoln has a good one, and also AXA, I think. So I could round that up. Whoever asked that question, if you'd be interested in a carrier-specific brochure rather than just this presentation, feel free to send me an email, jake@milnergroup.com, and I'll look into getting that for you.
I'll send you his name and everything there, Jake, so you'll have it.
Okay, never mind then.
All right, I believe that's all the questions we have.
Okay, thank you everybody for getting on the call. Remember to, I don't expect you to remember all the details. Feel free to give me a call or shoot me an email if you've got questions on how you can implement this or if you need an illustration. Thanks, have a great day everybody.